Good afternoon. This is Jim Barlow with OakTree Strategic Leverage. Hope you're having a great day. It's getting close to the end of the July. Here we are. 4 questions that could change the way you think about retirement. Using the inversion wealth framework to rethink risk, taxes, leverage, and protection. A paradigm is a way of thinking about or viewing the world. A paradigm is like the lens on a pair of glasses. If you put on red glasses, everything looks red. Laura Killam, a professor at Queen's University. Today I'm inviting you to try on a different pair of glasses. Kevin Worthen said, if the lenses are accurate, the paradigm enhances our understanding. If they are distorted, we sometimes make mistakes. The greatest financial mistakes aren't usually caused by poor decisions. They're often the result of logical decisions made within an incomplete paradigm. So here's the thought. Many people see life insurance through one lens as a death benefit, a policy that pays when someone dies. Institutional investors often see it through an entirely different lens as a financial asset that can provide tax advantages, leverage, liquidity, and legacy planning. Sometimes the greatest opportunities isn't changing the asset, it's changing the lens, getting a little different paradigm. So, a belief that I put together is I call it the inversion thinking framework. It's a different way to think about success and about any topic. Let me show you what this inversion thinking framework is. Most people ask, how do I win? What investment should I buy? How can I earn higher returns? What strategy will outperform? How can I get ahead faster? Well, what if that's the wrong questions? See here, the focus is on achieving success. Inversion thinking asks a different question. Instead of asking, how do I win? How can I fail? And then avoid, eliminate those things. Charlie Munger of Berkshire Hathaway fame, he said this tongue in cheek once, all I want to know is where I'm going to die. So I'll never go there. It's the same thing, just in a funny way. What could cause this to fail? Avoiding mistakes, avoiding, that's a tough word, stupidity is often easier than achieving brilliance. Traditional thinking versus inversion thinking. So, as I point out, how do I win? Seek opportunities, pursue gains, hope for good outcomes, focus on returns. But inversion thinking, we could I lose? Let's identify the risk. Let's avoid the losses. Design for good outcomes. Focus on the structure. Eventually, it moved. So, why do retirement plans fail? Most retirement failures are not caused by poor returns, they're caused by sequence risk once you're retired, emotional decisions, loss of timing control, taxes. inflation, unprotected leverage. These are the things we want to avoid. And then you'll have a better chance of success. The aversion wealth framework composes four things. Understanding this theory, aversion thinking. Then we find the structure that fits that theory. Then we leverage it because we found something that's protective. Then we let patience work its thing. Identify the risk, build the right structure, apply leverage carefully, allow time to work. Here's our theory in a pyramid fashion. Inversion on the bottom, structure, leverage, and patience. Let's review the steps a little bit quicker, more detailed. Version, what could derail this plan? Ask what could go wrong, what could permanently impair wealth, what could force bad decisions, what could prevent compounding. Understand these things very well. Then build a structure. It's the structure that determines outcomes. A strong structure includes tax efficiently liquidity, flexibility, protection for sure, proper ownership, risk management. Returns matter, but structure matters more. Leverage. If you build the right structure, you can do leverage. There is different levels of leverage. There's dangerous leverage, margin calls on a stock account, personal guarantees, outside collateral, forced decisions. But controlled leverage, we're doing it long term, non callable, structured, institutional. Then patience. Time is the ultimate wealth multiplier. Give it some time. Time, discipline, consistency, a structure strong enough to survive. The goal is not to be brilliant. The goal is to stay in the game. Core principles avoid risk first. Success is often less about finding extraordinary opportunities and more about avoiding predictable mistakes. Extraordinary outcomes are frequently the result of extraordinary structure consistently applied by ordinary people. A little bit more about structures, then we'll get moving on to those four questions. Most people focus on the investments. Successful outcomes depend on structure. The structure determines risk, tax, liquidity, leverage, behavior, longevity. Results are visible, structure is invisible. Quick example, in the In and Out hamburger, ordinary people, extraordinary consistency. Every burger is remarkably similar, not because the employees are extraordinary, because the structure is extraordinary. Their formula, the inputs, high quality, fresh, the process, the training, the accountability, the culture, the consistency. When the structure is right, ordinary people can produce extraordinary results repeatedly. This principle extends far beyond hamburgers. Great businesses, strong families, successful retirement plans, faithful discipleship all rely on structure. Of course, outcomes visible. Structure is what creates them. Structure before product. Pick traditional thinking, pick investments, chase returns, react to markets. Structural thinking, build the framework, control risk, control taxes, create flexibility, let compounding work. We don't begin by asking what investments we should buy. We begin by asking what structure helps me avoid losing. Greatest financial breakthroughs often come from not finding a better investment, but from discovering a better structure. So, the core questions for today. What if you could participate in market gains without exposing retirement assets to market losses? No losses? Retirement really changes everything. You're no longer accumulating, you're withdrawing. Losses are permanent, not temporary. Sequence risk moves hypothetical to lethal. Timing matters more than average returns. Income depends on the structure, not the market. Retirement, you don't get paid, be patient. Let me show you a simple case of sequence risk return. I've got two investors who over 5 years had a 0% return. I'm not sure it's a very cool story, I guess, but the first one had 20% in the first year, 10% in the second, 0 in the third. Then he had -10 in the fourth, and -20 in the fifth. And I just reversed it for client B. Does that make a difference? Their average return are exactly the same, 0. But let's look. So the first fellow, at the end of the year, after 20% growth and 50%, 50,000 withdrawal, he has 1,150,000. Second year, he has 1,215,000. Third year, he has 1,165,000. And then we have negative years. Eventually we're down to 748,800. Meaning negative years hurt too. But how about this other guy? Ooh, pulling 50,000 out in a negative 20% year. He's at 750,000 after just 1 year. Then there's the numbers. 511, same average return, and yet the one has 250,000 more. 46% more. Exactly. See, sequence risk can just be devastating in retirement. You avoid ruin. This matters more than chasing returns. Great investors survive. So we have a different approach. We use a cash value life insurance, index universal life. We have index interest crediting strategies, market like returns, but this strategy has zero downside, a 0% floor, and no direct market investment because of the structure. How indexing works in an indexed universal life policy. Most of your premium beyond the cost of insurance goes to the general fund of the insurance company. Out of $1,000 excess premium, $950 approximately will go to bonds. This money grows back to $1,000 in 1 year. We don't play with that. It's protected. It'll be back to our principal in a year. Then the other part, we take $50 and buy options. Options linked to an index of the market. So we have protection first. We're going to protect the principal. Then we're going to have growth second. That sequencing is what makes the structure transformative. We get market-like returns with no downside. Now, this is a lot of numbers, but I thought it'd be best to just show you the actual performance. This is from the literature of Allianz. Allianz happens to be the world's largest insurance company. They're huge, and they have more options than most people. I'll try to be fast on this multiple numbered page. Go down to the bottom third, classic. Oh, let me move up. Let me go below the bottom third. I gotta move my little thing here. Standard index allocation. The Standard Poor 500 index annual point to point. With this option approach, we have a capped product. We can only buy so much of the market to have zero downside. And the current cap on this product is 12.25. And here's the averages: 5, 10, 15, 20, 25%, 9, 9, 8, 8, 7. Okay numbers. Okay numbers. That's one strategy where you have zero downside. Then we have this classic index allocation. They have 5 different other approaches that doesn't have caps but has participation rates. And the two in the middle, Bloomberg and PIMCO, has 190%, 185%. We can give in these indexes, we can give you more than 100% with zero cap. So how they performed. We don't have the one for a long time, but let's look at the PIMCO, 7.18, 10, 9, 10, and the other one 9 and 10 for 10 years. This is higher participation. These are fairly conservative. Allianz wanted something a little more aggressive, but with no caps. And to do those, they had all they could do is buy almost 100% of this uh, market index. So 95, and you can see the performance there. And then this Standard Poor 500 futures, it was a 60%, but pretty good numbers on this strategy. And in addition, don't want to get into too many weeds, you get a 1% bonus on top of that return in this classic index. That's the middle one in the middle. You can choose, instead of getting 1%, you get 15% more of whatever return. And then there's another one, a 40% multiplier on the top with a 1% charge per year to get those returns plus 40%. Don't want to get in too many weeds, but there's the performance. So the first question, what if we could participate in market gains without exposing your retirement asset market losses? Well, we can. In the index universal life, we avoid market losses and we participate in growth of the market with no losses. Question 2, what if your growth could accumulate tax advantaged and provide income that may be received income tax free under current tax law? What if we can make this tax free? That's the question. So let me review the tax buckets of life. You have taxable accounts, you have tax deferred accounts, you have tax advantage. Let me quickly review them. So a taxable bucket, this will be a bank account that you're making interest on, or CDs in the bank making interest, or money market, and you're paying taxes as you go year to year on the earnings you made. Brokerage accounts are also taxable accounts. You pay taxes on the dividends you get every year. You'll pay taxes on the gains when you sell them. Taxable accounts. Then we have tax deferred bucket. This looks a lot more complex, but not traditional IRAs. You get to deduct what you're putting into it from your income. Saves you taxes now. But then when you withdraw, it's taxable, tax deferred. Tax don't have to pay tax now, but you pay eventually. There's IRAs, there's 401ks. There is limitations on how much you can put in per year. 403bs are for schools and nonprofits. SEP is simplified employee pension for self-employed small businesses. Then there's a simple IRA for small businesses or deferred annuities. They're deferred taxes. This is the second option. Then there's the third is tax advantage. We use the word tax advantage because it's is better for compliant issues because we have some asterisks at all times. Roth IRAs, you don't get a tax benefit now, but it grows tax free. Same with 401ks. That's a good positive that I encourage people to do. Problem is its limitations on how much you can put in per year. Health savings accounts. When I was at Zions Investments years ago, I always had a health savings account. My kids were young, and I saved taxes on the funds I went into there. If you should do it, especially if you have children, teenagers, and medical expenses. Then another tax advantage is properly structured cash value life insurance. Let me try to give you the details on that one. Oh, I forgot to put this in. There is a retirement tax trap. The trap is that most retirees have substantial assets in tax deferred accounts. They're going to pay taxes someday. Guess what? I fell into this retirement tax trap big time. Every year when it was time to put into my 401k and my businesses, I wanted the tax benefit then. And I'm paying the price today. I am much more than I should in tax deferred accounts. It's a mistake I can't retract. I can't fix. I can kind of try to play with it, but I can't really fix. So let's talk about why life insurance received favorable tax treatment. Life insurance was designed first and foremost to provide families with financial protection at death. Because of this unique role protecting families, the tax code provides favorable treatment during accumulation, distribution, and wealth transfer. Here's the three. Accumulation. Money accumulating in a life insurance policy, a cash value life insurance policy, is growing tax deferred. Sounds like that second bucket, Jim. But transfer at death, when the owner of the policy, the insured of the policy, passes away, it goes income tax free to the heirs. All the tax deferred growth that was there accumulating for many years become boom, tax free when it's transferred to the client. This is the big tax advantage the IRS, the government wants. They started this when they started income taxes in 1918. They've always had life insurance become tax free. Now, you notice I put a little middle ground there. Distribution, not dying, but you can receive money out of your life insurance policy tax free by doing a policy loan. In other words, the money's staying in there. You're just borrowing against the policy and not paying taxes. This is the strategy we use to give you a tax free retirement in this life insurance policy. One vehicle, life insurance, with tax advantages during life and at death. Another thing I want to mention, I have to give a little background. If you cashed out this life insurance policy before you passed away, you'd pay taxes. So we add a loan protection rider to every policy. When you have pulled out almost all the money, we have this rider that this policy is going to be enforced your whole life. We're not going to let this thing blow up and you pay taxes on all the internal money. If you have questions on that, give me a call. So why does all this matter? Traditional investments, taxed while earning, taxed when sold, taxed when distributed, but it's not just what you earn, it's what you keep after taxes. Question number 2. What if growth could accumulate tax advantage and provide income tax, received income tax free under current tax law? Boom. After tax income matters more than pre-tax. We can do it. Question 3. What if institutional leverage could potentially increase your retirement income by 50 to 100%? No increased return, nothing to do with the investment because you have an investment with no downside. No downside. Why not do some leverage to give you 50 to 100% more income? Well, can we? You already know kind of the answer. You know, the wealthy think differently about leverage. Banks, their whole premise is leverage. They're leveraged 20, 25 to 1. That's they borrow money from the savers and loan it to businesses. Corporations use leverage almost huge percent. And those guys that don't use leverage could be taken over because they're not being efficient with their funds. So corporations use leverage. They issue bonds. Real estate investors, how many people do you know who buy real estate and pay cash? They use leverage to get that money, a much larger sum of money than they have, growing at great rates. There is good leverage and there's bad leverage. There's speculative leverage, there's productive leverage. Margin calls, we've talked about personal guarantees, outside collateral, forced liquidity, excessive leverage, loss of timing control. Leverage becomes dangerous when it creates possibilities of a forced decision at a wrong time. But Kaizen is a structured approach to institutional leverage. Client contributes, actually 5 years of payments. Institutional leverage, we get a bank to put in about 2.5 times what you're putting in. We have a life insurance policy with all the life insurance benefits and living benefits, structural advantages. Here we have no margin calls, no outside collateral, no personal guarantees. Let me give you a case study. This is a simple one, not like some of my others and other webinars. A male, age 40, contributes $25,000 a year for 5 years, $125,000 total. His objective is to get a retirement income from these assets. Assumptions: excellent health, non-smoker. We're going to illustrate this at 6.84%. That's regulated by the National Association of Insurance Commissioners. I did this illustration on June 15th. The numbers really haven't changed. So let me show you how it looks. With Kaizen, and the borrowing, we can give it a 72,000 income. From age 65 to 100, this person will be pulling out 2,592,000. That's, remember, that's, you put in 125,000. It grew at 6.84, always 6.84, the illustration. And we have a 72,000 income. If you didn't want to do the leverage, we didn't do the borrowing, we just did the policy, your self-funded would be an income of 46,000. Same returns, same investment, but no leverage. 56% more. 56% more income. And if you did this in a regular after-tax investment, paying taxes as you go every year, same return number, you'd have 26,615 is income starting at age 90. That's, well, not quite half of the 46, but by a bit, quite a bit lower. That's 270% more in Kaizen. Same investment, and the safety is all there. I want to show you a historical thing. The very first policy was issued in 2012. The statement comes out every June 27th. I haven't got a new one on this one for 26 yet, but this person averaged 7.85 from day one through June 27th of 2025. The average interest rate on the borrowing is 3.95. That creates what we call a spread. We take the 7.85, subtract 3.95. That means this person on the borrowed money made 3.9% from 2012 through today. So 7.85 on your money, 3.9 on the borrowed money. I put down here long-term historical SP 500 average is 10%. Well, Jim, that 7.85 isn't 10. I want my cake and eat it too. Can't I have 10? Well, remember, this is tax advantaged. So if we do taxes on this 10% account, and I just do a 25% tax, now we have something that's right in the ballpark. 7.5 for the market, where ours was 7.85, tax free. Another point I'd like to point out, based on this hypothetical, NIW, that's the designers of Kaizen, the founders, they did a historical analysis looking back at the markets to the 1930s. And there has been no rolling 15-year period of time examined ever that has produced a spread less than 2%. I showed 3.85 spread since 2012. Well, they're saying there's never been a time less than 2. So what's our spread? What are we going to make on our borrowed money? Probably minimum 2 to 3.85, maybe higher than that. We're making money on our money, and we're making money on borrowed money, and it's tax-free at no downside. Question 3, what if institutional leverage could potentially give us 40, 50, or 100%? Well, we did it. Leverage can be powerful when properly structured. Question 4, what if the same strategy also provide life insurance protection, chronic illness benefits, long-term care benefits, disability protection? Well, we do. These policies have these different riders attached to them: disability, illness, chronic long-term care. And that's immediate from the day you buy it. So that was an easy conclusion. We have all these benefits. So there's the 4 questions. The recap, can I reduce downside risk? Yes. Can I improve tax efficiently, make it tax-free? Yes. Can I use leverage intelligently? Yeah. Can I protect my family and myself on top of that? Yeah. The 4 questions. Got another question, though. What if the biggest risk isn't market risk? What if the real threat is market losses, behavior mistakes, poor structured taxes, health risk, longevity? Well, that's where our inversion wealth framework comes in. That's where we're looking to always think protectively, then find the structure that fits it. Kaizen is it. I love it. I wish I had it available as I was a younger man. I definitely have it. Most financial plans focus on returns. The best plans focus on outcomes. I hope you've enjoyed today. There's my phone number, my email, all that kind of stuff. And I got a QR code on the right. This QR code will give you to a landing page where it has videos on Kaizen. 10 different chapters on all the little different pieces of how it works. You can spend all the time you want reading and studying about it on this tech site. I won't know you're there. It's not something that I get a notification of. And when you're ready for some help to help this set up for you, your family, I'd be happy to be of help. That's our presentation day, 11:37. Oh, I'd like to make it a little shorter. I'll try to be a little faster next time. But for all of you who have attended, I hope it's beneficial. Type in your questions. I'll be looking them over as I can. Have a great afternoon. Bye.